In today's episode, John and I will be discussing that one piece of a financial plan that many Canadians are missing. And it's either because they don't believe in it or because they're just too lazy to get started. And that's insurance, life insurance, disability insurance. Those buzzwords that you hear about in financial services and things that are talked about, but not many people like to discuss their mortality and things they should be doing as part of their financial plan. So, John, why don't you get us started?
Yeah, absolutely, Carlos. So just like you mentioned, it feels like sometimes we're just the bearer of bad news, or we're having to be the ones that bring up, you should get life insurance. And that'll be our primary focus for today. I know you touched on critical illness disability. That'll be for another video. We'll focus specifically on life insurance for today because we have actually begun to notice it's kind of the missing part of the financial plan for a lot of Canadians today, for reasons like you mentioned. But we'll kind of focus on two different segments, I guess, pre-retirees and retirees, and how life insurance can really be an extra value add to your overall financial plan. And I guess we'll get started with the first and most obvious form of life insurance, and that's for those who are maybe on the younger side, just starting a family, have major debts, I guess, like a mortgage or things like that. These are the perfect opportunities for you to start thinking about protecting yourself and protecting your family, really, in your overall financial well-being. In its absolute, core, what life insurance is going to do is it's going to protect your family if you were to pass away prematurely, and help provide a lump sum amount of money to help pay off major debts, help pay for kids' education costs, things like that. And the way insurance works is it's all based on mortality rates, I guess, if we're going to get dark on that. It's based on mortality rates, and obviously the younger you are, the more healthier you are, the cheaper those premiums are going to become. So that's why when you're having some of these major life changes, that's when you should start thinking about, getting insurance in place just to make sure, first of all, you are insured, because who knows down the road if anything changes health-wise, but not only are you insured, but you're locked in at a pretty low rate because you're young.
Yes, John. We talk about as financial planners that you need a plan in place. And the plan works if you're working, earning income, continuing to get bonuses, spending the same amount that we discuss on an annual basis. But what happens when you lose your job? Or what happens if you pass away prematurely? That's why insurance is in place. So, John, when you were discussing insurance, we're talking about term insurance. There's a locked-in term where your premium is guaranteed for that length of time. And typically this is for pre-retirees, people who are getting into debt, accumulating their wealth, maybe having children. You want to have insurance in place to ensure that if you pass away prematurely, that this plan can still continue. You have enough income to come in to live the lifestyle you want to live. You have enough income to pay off those big debts, mortgages, loans, and the like. And typically these terms can be between 10, 20, 30 years. So find the term that makes sense for your situation.
Absolutely, and term insurance essentially just becomes a protection, right? It's we can come up with the best financial plan possible, but if one spouse passes away prematurely, that plan's out the window, right? So insurance is essentially just your plan B, your backup, just in case anything were to happen to you. Now on the flip side, if we start thinking about more for our older Canadians into retirement, there's another type of insurance that may even become the next asset class for you, because we're already familiar with RSPs, TFSAs, and open account, but there's actually an investment portion that could be part of a whole life insurance policy or a universal life insurance policy. And I'll tell you why this becomes a bigger opportunity for a lot of Canadians now, primarily because the changes that just happened recently with the capital gains inclusion rate. So with capital gains inclusion rate going up, that essentially means there's going to be more taxable income to you if you have a non-registered account or an open account above $250,000 worth of capital gains. And if you're not paying that in your lifetime, you're going to be paying that through the estate. So estate taxes, hypothetically, are going up because of that change to the taxation rate. That's where a whole life insurance, permanent life insurance, whole life or universal life will come into play to help mitigate some of those taxes. So this has become a lot more of a lucrative strategy for a lot of our retirees. If you do have a large open account, non-registered account that you don't plan on utilizing the entirety of the amount, and you're probably going to pass on that money anyways to the next generation, you can use that money to fund a life insurance policy, so to make sure you're paying the least amount of tax when it comes to estate time, and even while you're living.
Yes, John. We've essentially just touched the surface of insurance and the types and the needs. What you should be taking away from this video is there's always an opportunity to have life insurance on your lives. As a pre-retiree, typically you're going to be using term insurance to cover debts, lost income. And as a retiree, as an older Canadian, you'll be using permanent insurance as either another asset class or to cover a fairly significant estate tax bill.
Yep.
For those of you out there with any questions about insurance, whether it makes sense for you, what you could afford, please visit our website at www.tmfg.ca or contact the office to set up an appointment. Until next time, I'm Carlo Cancino.
I'm John Iaconetti.
And this has been Ask TMFG.